My name is Jake. Welcome to the channel. We did it. We sold a rental property here in Austin, Texas, and we transitioned all of the money from that rental into our dividend growth portfolio. This is really shocking because we had our tenants in the lease early. We anticipated not selling this rental for another year and a half, but life happens, and because life happens, you have to be flexible. So with that, I want to share with everybody some of our plans and what we've done with the $300,000 that we got from the sale of our home that was all tax-free. Because we lived in the home for 2 years, we are paying zero, and I repeat, zero capital gains tax on the sale of our home here in Austin, Texas, because we lived in it for 2 years. So in this video, I'm not going to go and I'm not going to break down all the numbers of the sale of the home. I really just want to focus on what we've done with the money, how kind of our goals and priorities have changed given the circumstances that we're in, right? We had the lease, and we thought we were going to be renting it out for another year and a half. The tenant broke the lease. We decided, you know what, let's sell the rental and let's just put all the money into our dividend growth portfolio. If you want to learn more about the actual numbers and how we leveraged real estate to reach FIRE faster, I would recommend watching this video, how we invested in real estate to FIRE faster. I will leave a link in the description below as well. You can check out that video. In that video, I kind of go through all the numbers and some details around how we invested into real estate to, grow our net worth. So in this video, we're just going to talk about what we're doing with that money, how our strategy has shifted a little bit, because my portfolio today looks pretty different than it did a couple of months ago. And the reason why it looks different is because things in our lives, my wife and I, our lives have changed just kind of out of the blue, right? That's the beautiful thing that we call life. You have all these wonderful plans in place, and then all of a sudden the world throws you a curveball and you kind of got to pivot and you got to roll with the punches and kind of figure out what's happening. Speaking of rolling with the punches, what is going on in the world here in 2022? It just feels like we're living in a circus, and it kind of feels a little like this.
Dana, I love you. G.I. Jane 2, can't wait to see it. All right? I'm out here. Uh-oh, Richard. Oh, Will Smith just smacked the shit out of me.
Keep my wife's name.
Oh my gosh. I am actually really proud of that. I wasn't planning on saying rolling with the punches, but it fits so well with this meme. Oh my gosh. I cannot turn on social media and not see a Will Smith meme. I don't know what it is, but every social media account that I have is just flooded with Will Smith and Chris Rock. Oh my gosh. All right, cool. So let's talk about some dividend stocks. And before we dive into the portfolio here and I walk through each individual position, I want to share with all of you why my mindset has changed quite a bit when it comes to ETFs and individual companies. While I'm explaining this, I'm going to have something pop up here on the screen, and a lot of this is going to make a lot more sense as I'm talking. So when I first started learning about dividend investing, I thought that I had to pick all of the winners. I watched great videos from PPC Ian. I heard Ian trash talking ETFs, and I thought that, okay, if I want to be a dividend investor, I have to only invest into individual companies. I have to beat the market. I have to, pick the best, only the winners. And that caused a lot of anxiety and a lot of stress that was really unneeded. And so when I first started learning about dividend investing as a viable option for my wife and I to reach FIRE, I thought to myself, okay, I have to pick the winner and I have to be always right. And if I'm not right, I diversify the portfolio enough so that, it works out. Over the last couple of years, I've understood that, I'm a smart guy, but I don't think I'm smart enough to be able to predict the future. And I think there's really not anyone out there on planet Earth that can do it reliably over and over again, and especially over the long term when we talk about generational wealth. Yes, some companies are going to be around over the long term, but there's going to be a lot of companies that are not going to be around. There's going to be a lot of companies that get disrupted, and I don't believe that I can say, with a straight face and say, I know exactly which companies are going to be around, because I don't. And because of that, I want to focus more on indexes while still having a few individual companies that I believe in, that I believe are really good dividend companies. But my overall strategy, I want to focus a little bit more on ETFs and have more exposure, a higher weighting into ETFs. Now, I know everybody's not going to agree with me, and that's completely fine. Everybody has their own risk tolerance. Everybody has to understand what's right for them. But for me, when I see this, when I see all of these great companies come and go, for me, it's like, okay, I don't have a crystal ball. I don't know what the future is going to look like in 10 years, 20 years, and I'm not going to sit here and pretend like I do. So that's the reason why I've skewed the portfolio more towards ETFs. So when I think about this portfolio, our goal here is to live off of this portfolio in the next 1.5 to 2 years. That is our goal. And because our goal or our time horizon is so short, we've decided to focus on a higher starting yield. So what I'm focused on is a balance between value and growth. And so a lot of the companies, a lot of the ETFs that I have in here are maybe not going to be necessarily the right ETF for everyone watching this video. So I want to make sure when you're watching this and when I'm going through these companies and these ETFs, you have to do your own homework. You have to understand, is this the right ETF for you? Because I promise you, some of these ETFs are not going to be the right fit for everyone. Some of these ETFs are truly just income ETFs. They're not growth ETFs. And so that's important that if you're a newbie investor, you're new to dividend investing, you have to understand just because it has a high, an investment has a high yield does not necessarily mean that it's the right investment for you and your goals. Right off the bat, our portfolio value has exploded, right? We're just over $700,000, and that does not even include our real estate portfolio. We also have a real estate portfolio here. So we have cash flow and we have real estate. Okay. And so in this portfolio, if you were to watch some of my older videos a couple of weeks ago, there's quite a big difference between the portfolio today than a couple of months ago. And the reason why that is because of the changes that we had with our rental property. We thought, we had another 1.5 years before we were going to have this money. But because our plans and because life has kind of thrown us these curveballs, we've adapted to our situation. All right, so let's take a look at some of the investments here. The largest holdings in our portfolio, we have 6 ETFs. Now, some of these ETFs you're going to be familiar with, some of them you're not going to be familiar with. The very first one here, QYLD and QYLD. These are covered call ETFs. I am really excited about these ETFs because these ETFs really serve one purpose. They generate income. They generate income that I want in early retirement. These are not growth ETFs. Okay, these yield 10, 12, 13, 14%, and they are massive ETFs at generating cash flow. Okay, and so for my wife and I looking to retire in the next year or two, these are amazing investment vehicles for us, in our opinion, when it comes to what we're looking to do. Okay, and I've shared an entire video on QYLD in the past. If you have a long-term time horizon, QYLD is not the best investment choice in most cases, even if you reinvest the dividend. So something to keep in mind. But because we plan on living off of the dividend within the next couple of years, I absolutely love these ETFs. All of our ETFs here, DGRO, JEPI, VYM, and SEHD, and the others, they all hold a 10% weighting in this portfolio. So that means 60% of our portfolio in this portfolio, the cash flow portfolio, is in ETFs, right? And you have to understand these cover call ETFs, even JEPI down here, there's different tax treatment for these than SEHD, for example. With QYLD, most of it is return of capital. So it's just lowering your adjusted cost basis. It's not actually, when it comes tax time, you're not actually getting charged on the dividend. You're just lowering your adjusted cost basis until it goes to zero. So I don't want to confuse anybody. If you're not sure what that is, I would, kind of research on that. But we actually don't pay any taxes up in the beginning when it comes to the dividend here from QYLD, because it is, in most cases, return of capital. But yeah, I don't want to go too far in the weeds on that. But yeah, everybody knows that I have SEHD, VYM, DGRO. This is going to be my strategy here for my ETFs in this portfolio. I am really excited about this. All right, now let's take a look at the individual companies that we have in our portfolio here. what you'll notice is that every single individual company is allocated the same. They're allocated at 2%. So we're not overweighting in one individual company. What I'm doing is I'm focusing on a mixture, a balance of growth and value, right? Coca-Cola is growing much slower than, for example, Target or Union Pacific or Costco, right? Kimberly-Clark is growing much slower than Costco, but I like having them both in there because there's a balance. I get the current income from Kimberly-Clark today, but I also get the growth from Waste Management and AbbVie, for example. So that's the reason why I have it in here is, have these in here is one, I'm a believer of the company. Second, the fundamentals check out, right? In some cases, some of these companies are overvalued at a particular time, but that's fine. Over the long term, I still believe in the company. When it comes to diversifying across sectors or industries, I'm not so concerned about diversification into industries with individual companies because I have such a large exposure to ETFs. In these ETFs, I have a larger exposure to other, different industries, right? I have oil telecom in some of these ETFs. I have more financials in VYM, for example. I have more discretionary, more growth in SCHD, and much more growth in DGRO, for example. So I get a little bit of a mixture of everything when it comes to these. So when I look at both portfolios combined, when I look at my real estate and my cash flow portfolio combined, I have just around a 5% starting dividend yield. And the historical record here does not go all the way back because of these covered call ETFs. They don't go back past 2020. But if you look at both of these portfolios, I have a total of 38 holdings, a decent expense ratio. This is mostly because the covered call ETFs have a higher expense ratio. And if you look at the real estate slice here, you can see, it has a little bit of a lower dividend yield. And this is because I've skewed it more towards, I've added a little bit more growth. Before I had these other growth REITs at a lower percentage, but you have real estate here. I have cash flow here. The cash flow, just even 2 weeks ago was yielding almost 5.5%. So the market has rebounded quite a bit. But yeah, I have 26 holdings in this portfolio. For me, for now, I feel very comfortable with this. It's not overcomplicated. It's very straightforward. It's very simple for me to, it's not something that I have to stress about or really have to follow up on. That's been really key. Here in the next couple of years, I'm going to still nerd out on different stocks and different companies, but I want to travel. Like my wife and I, we've already thought about all the places that we're going to go visit. We have Portugal, we have Panama, we have Costa Rica, we have so many things we want to do. And I would rather, focus on that and enjoying the second stage, the second phase of our lives and not just be focused on investing in early retirement. So that's kind of something more personal, when it comes to that and our priorities. But that is, in a nutshell, I guess you could say, the portfolio here and what we've done with the sale of the home. So we transferred over in total $300,000 from the sale of our home. And with M1 Finance, you can only transfer $50,000 a day. And when I use the word only, I feel really weird saying only because that's a lot of money. You can transfer $50,000 a day. And here on the 29th, we invested $150,000 and we bought the following companies, ETFs in the portfolio. It's just kind of crazy to me to see, on one day we invested $17,000 into DGRO. Like this is a lot of money to me. But yeah, it's just crazy. I think back, just about 3 years ago when we first, when I first tried out M1 Finance, I transferred $100. And fast forward a couple of years, the market it's just, the experience has been absolutely insane. But when I look at this, it's by no means to brag or anything. I mean, if you've watched my other videos, you know that I try to be pretty sensitive to that. The only reason why I share this is I consider myself a normal person. And if me as a normal person can do this, I truly believe that everyone watching this can do this too. And that's why I share this, right? It's not to brag by any means. And if you're new to the channel or if you've been following the channel for a while, all of the money that we put into this portfolio, 100% of it is from our day job and from investing into real estate. Like that's everything. Nothing here from YouTube. I don't make a lot of money on YouTube. Like you watch these other videos of, hey, this is how much YouTube paid me from blah, blah, blah. It's like, I don't have a lot of ads on my videos. I don't do sponsorships. I don't monetize YouTube as much as I could, I guess. And all of the money that we get from YouTube, which is it's not a lot. I mean, I definitely couldn't quit my day job. Is everything that we get from YouTube, we invest into a retirement account. And so none of the money from YouTube actually goes into this portfolio. So, and, but yeah, and I'm happy about that. I'm excited that I'm able to, do this from working and, share that just your normal person can do this. And I kind of consider myself normal. I'm kind of weird. I don't know. I'm weird, but normal. I don't know. But one last thing, is encouragement to everyone, who may be thinking to yourself, oh man, this is like climbing Mount Everest. You have to remind yourself that you got to start somewhere, right? When I first started down this path, I was, so excited. I remember making like not even $100 for the first couple of months. And then once we made $100 back in September, this was over like 2.5 years ago, I still remember how excited I was when we made over $100 in one single month, right? And this first year and a half, we were just figuring things out, right? Figuring out, our time horizon, figuring out what our priorities were, what we wanted to do in life. And it wasn't until, about a year and a half later when we really said, okay, hey, this is the plan, this is our goal, and this is how we're going to get there. And, that's when it really took off, right? And I'm so excited, with the 300,000 coming into the portfolio now here in March. I'm so excited to see how this chart here is going to continue to go up and to the right. Because if I do the math right, I believe we got 720 plus 125 times 495 or something like that, I think is what we actually have. Right now we have just over 40,000 in annual dividend income. I talk to my wife about this all the time. Today, if we wanted to, we could sell this house. We could move to Panama. We could move to Portugal, and we could retire. We never have to work another day in our life. But we're not there yet. We still want to, right now we've reached lean fire. We have reached lean fire, and a little bit beyond lean fire if we were to sell this house that we're living in now, but we don't want to sell it. But we've officially reached lean fire. But I don't know about you, but I don't want to be bored all day, not working, but I can't do anything because we don't have any money. We have to, so that's really important. We're anticipating that we're going to reach fat fire here in the next year and a half, 2 years. And yeah, I'm really excited about it. If you're new to the channel, I hope that this is something that excites you. And, if you've been following the channel for the last couple of years, yeah, thank you so much for staying with me and watching my videos and being a part of this. And yeah, I'll catch everybody in next week's video. We'll see everybody.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.